All right, so Lou, we had a second consecutive down day today, but today was not like yesterday. So I'm going to show the differences, and today was actually had a lot more of a bearish tone to it. We're going to talk about why, how that showed up, what patterns it showed up in. But then we're going to also talk about then what do we expect to see starting tomorrow, maybe the day after, maybe Friday. What do we expect to see coming off of this 2-day streak? Do we expect more bearishness? Do we expect a bounce? What's more likely? What's less likely? Why? What technical patterns would suggest one's more likely than the other? So we're going to break that down in today's video. We're also going to take a look at what's driving the risk off move today. How much of a risk off was it? So I'm going to show you that, and then we're going to take a look at our trade idea to kind of give an idea of what we expect to see coming out of today. Our trade idea will show you one way to take advantage of those expectations with a specific example. So let's go ahead and get started. Today is Wednesday, November the 10th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's go ahead and start off taking a look at the S&P 500 with the market forecast indicator like we always do. And you can see a 2-day losing streak. That's rare. We haven't had one of those during this stretch. It was long enough now to get the near-term line into the bearish territory, but did not get into oversold territory. You also see the momentum line dropped into oversold, again, below the 20th percentile is oversold. So the momentum line got down there at the same time that the intermediate line still up above 80. So very good. This is a good bullish pattern here, a bullish bounce pattern, kind of a buy the dip type pattern. It's called a bullish intermediate confirmation signal. It's technically, the definition is the intermediate line above is bullish, specifically above 80 ideally, and the momentum line is below 20. So that combination is a bullish intermediate confirmation signal. Add to that the near-term line being in bearish territory. This adds to the strength of that signal, which suggests that the momentum line will bounce out of here because it's very sensitive. Right? It goes down and up, down and up. So you expect that it will bounce out of here, and at the same time bring the near-term line up out of it with it. And the near-term line can go up and stay up for a while, up above 80. So that's kind of the expectation here. Remember, we are in a bullish convergence mode. So let me really briefly bring this back up here. You can see the MACD has crossed below its moving average. So we are going to start to converge. Last time, one similar to this, a couple of these, you can see that some of these convergences here after the MACD peaked. You can see we still stayed above the 8-day and 17-day moving averages even after the convergences. So I expect that we'll bounce off of here and continue to grind towards new all-time highs, and maybe not get a new all-time high. If we do, maybe just a little small one before ultimately we get the MACD a lot closer to zero. We get the stochastics a lot closer down to bearish territory itself. You'll see an example of that with our trade idea of the day or later on in the video. If you take a look at the NASDAQ, that was our most bearish stock. That the near-term line did get into the reversal zone, but just barely. So again, a good bullish signal there. That's a good bullish opportunity. The Russell 2000, very similar, oversold or intermediate confirmation signal with the near-term line in the reversal zone. So a couple of down days, but it's a good buy. It's a good bounce signal. We can take advantage of this and jump off of here. One more, looking at the Dow Jones Industrial Average, same thing, oversold momentum line with a strong bullish posture, and the near-term line in bearish territory. Now again, nothing's ever 100%, so we could very well bounce, or we could very well get more bearish, but it's all probabilities, right? So the probabilities of a bounce from here, even if it's not tomorrow, even if it takes another day, but the probabilities of a near-term bounce from here is a lot higher than it is that will break down, simply because of the strength of the trend that we're still on right now. When we look at some of these other indicators, you can see the weekly candle. So far this week, it will be the first week that we did not close above the prior week's high. Remember, the Hakinyashi close is different because it's an average of the open, high, low, and close for the S&P on the week. So we're not, that average is lower than last week's high. That after 3 weeks in a row of closing above the prior week's high, which is very bullish. But you can see, when you're typically on a good bullish trend, it's very hard to close above the last week's high. It doesn't happen very often. So we'll see, but it does start to lead to smaller Hakinyashi candles, and eventually that leads to a transition. So we'll kind of watch to see how that occurs, especially considering the PPO is diverging, right? We've already got a higher high in the S&P. We're definitely not going to get a higher high in the PPO, more than likely. So we'll just keep our eyes on that long-term divergence. Takes weeks for that divergence to play out because it is a weekly chart. So take that with a grain of salt there. Obviously, we have red arrows now on the S&P, the Dow, and the Qs. We don't quite have one yet on the Russell, but that's why we don't have green shading anymore on those three. So we don't have light pink shading either. So we're not quite to, we're not going to get a red arrow. You have to have 3 red arrows to get light pink shading. So we're not there yet, and we don't have to get light pink shading. We can alternate between green, clear, and then green. So we'll kind of keep our eyes on that. Obviously, 3 red arrows. But just 1 red arrow. The MACD is usually the first red arrow in the set of 3. When you look at the 2-line versions of that indicator, you can see we're below the 8-day moving average. Again, it's very similar to that time frame right there, where we also had a 2-day. We had a big long run, very high MACD. We had a 2-day losing streak that closed below the 8-day. Then we kind of just fiddled around with the 8-day and the 17-day for a few weeks, a couple weeks there. While the MACD converged and stochastics converged. And eventually we tested the 50-day. We bounced, but I don't think we test the 50-day here. I think we converge for a while. We bounce up, and then these lines converge a little bit more. These lines come down. Then we might retest at that point. But again, the MACD, the stochastics, or the 30-day moving average getting above the 50 is a good sign. Again, we haven't. The last time, there's a few times over here where the 30-day got below the 50 just briefly. Actually, it's right there. We got briefly below, and then we rallied back up, and then you can see the 30-day in blue and the 50 days in orange. You can see the 30-day stayed above the 50 this whole time, all the way. A few little close calls, but stayed above the 50 the whole time until just now. That's what happens during intermediate pullbacks. The 30-day drops below the 50. Well, right now we're just crossing back above. So you expect, again, if it's and really this period in April, this was a pretty darn close. We were pretty close, and we were pretty close in intermediate pullback. Remember the Nasdaq there in April, we did get a pullback, and so the 30-day did drop below. And again, we had another pullback in May. The 30-day dropped below again. Before getting back above the 50 and then rising until this last pullback here. So the 30 days just now rising. Can we have this kind of period where we have another kind of a pullback, then a pullback again on the S&P this time, and not just the Nasdaq? Definitely. But even there, you can see you converged for a while, and you stayed above the 8 and 17 for a while before you finally diverged with a bearish divergence, and the stochastics broke below 40. And the MACD broke below 0. And we got below the 17. We didn't bounce back up. We tried. We got to the 17 and fell back down. So again, the odds of, that's a possibility of something that can happen right now. It's a lower probability. The higher probability is we bounce up, but not very much, right? We just grind up. The 8 and 17 days start to converge on each other as we're pointed up. The MACD moves towards 0. The stochastics moves towards 50 and 40. And then we bounce off of the 17 and start a new leg higher at that point. So that's kind of what I'm expecting to see here. Obviously, looking at some of the other oscillators, the SPY is still very much in bullish breakout mode. The negative indicator is above 20, but the positive is not anywhere near below 25. So we're still in a bullish mode there from that perspective. When you look at the RSI and the CCI, we're still above 60. We're still above 0. So, it can pull back to 50 and even a touch below 50. It can pull back to 100, maybe even a touch below, but then get right back up, right? That's kind of what you watch for. As long as you don't drop below 40 and you don't drop below, this negative 200, negative 150, negative 200. So, so we're okay, right? This is very, very normal. That was the look at the Ichimoku cloud. We're still well above the cloud. In fact, we're still above the Tenkan line. We still have a very strong trend. Very strong trends don't end on a dime. So that's why I expect we'll continue to grind up, because it's kind of very similar to this. Again, we were above 5 and 80 at that period too. We tested the Tenkan, and we stayed above the Tenkan for a while before the trend ended, and we started a new one later. So that's kind of what I see going on this particular time as well. Again, barring any catalyst that might change things up, or right now that catalyst, if anything, might be inflation. We'll talk about that more, inflation here later, but That's the only thing I can see that might change that up there. Let's take a look at the intraday chart. Obviously, a lower high and a lower low. We close below the low. So a bearish candle, first one of these bearish candles that we've seen in a while, closing below the low there. Obviously, the Qs was more bearish. We were well below the low. And IWM also closed below the low point. So now, again, to reverse that, we'll probably get an inside day or two here. So kind of really watch how we trade tomorrow to see, these orange lines will be the green lines. If we stay inside of this orange range, then okay, we bounce up. We'll bounce up off of this. If we get another set of lower highs and lower lows and we close below 236 tomorrow on IWM and the equivalent for all the others, then again, more bearishness. I think that's the less likely scenario. I think the more likely scenario is we get some kind of inside day right here between between the low of that we got today and the low that we got yesterday. So kind of in this area is what I would expect us to see. That's the intraday low. If you look at today's volume and trading range, you can see that we had about average volume 70 million. The trading range, again, if you look at the gap, 467, the high. So the high of the day was right on yesterday's close. So we actually did fill in the gap completely, right up to the dot. So no gap there. So 5.34 is our total range, including the overnight. 3.81 is the average. So we were above average on the range, 5 points. That's actually above 1% when you look at it on here. 1% is 4.6 points. So 5 points is not only above the average, but it's also above the 1% mark. The volume is 70 million right there. So that's a relatively bearish day, right? Not so bearish that it's like so extreme that you just bounce, but bearish enough to be above these averages and be able to pull them up without being so extreme. So, we don't want to see that tomorrow. We don't want to see another bearish day with lower highs and lower lows, closing below the low, with, again, 80 million, 5 to 6 point range, 80 to 100 million shares traded. We don't want to see that tomorrow. So, again, I think the higher probability is an inside day in a small range and low volume. But if we follow up tomorrow with a day like today, then, again, wouldn't be the best scenario there. And I don't expect that to be the case. I expect the more likely outcome. If you look at the VIX did eventually finish at 85. We got above 85. We pulled back to 85. I think this is going to act as a resistance and will stay down. If it doesn't, then 90% will be our new resistance level like it was over here. See, 85 was support, and we bounced and we hit 90 as a resistance and then broke support. Now we're using 85 for a resistance, right? Remember, this is intraday, so the close that matters. So we did ultimately close at the 85% mark. We close up above 18. I think this is a good move on volatility that now will grind back down towards the 80 level, right, before we really get going on any kind of pullback with volatility to the upside. So, and it's actually a good thing here because volatility has been so compressed that the last couple of days it's allowed this range to get over 5 points. It was just barely over 3 points going into the last couple of days. So for it to now be above 5 points is better on a monthly candle. You can see when you get the smaller ranges, this was 4.5 points. You get these smaller ranges here, 3.9, before you get the volatility spikes, and we don't want to see that. 4.67 over here. So getting above 5 in the last couple of days is actually a good thing for the broader market. It's going to allow us for another week or two to stay, near this closer to the 15 level than getting above 20. So what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comment section below, especially if you disagree. Tell me why or what charts or indicators you're looking at that suggest why you're a lot more bullish than I am and why I'm expecting kind of a grind higher. You might be expecting more of an explosive move higher. Or tell me why you're a lot more bearish than I am. Maybe you think this pullback is more than just 2 days. Tell me what indicators are you looking at that would suggest that is our expectation. So post those in the comment section down below. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us, one, that you liked our video today, and two, you want us to do another one tomorrow. Quick way to give us feedback if you like our stuff. Of course, if you don't like our stuff, you don't have to click on anything. You don't even have to watch if you don't want to. Also, comment down there, or what stood out to you, what questions or comments do you have about anything I discussed. Post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these things over here on the right. If you click on this image, it takes you to our Market Outlook Live page. You can also get there by clicking on Market Outlook Live Trade Review. That takes you to this page. You can see all our today's Market Outlook Live. Here's where I reviewed some trades that were still in from prior Market Outlook videos. I also put on today's trade idea already before the market closes. I do that at 3:30 Eastern Time on this page on Monday, Wednesday, and Fridays. Here's all the archives down here. Also, you can see our upcoming classes we have. If you click on View More right there or come up and hit Trading Rooms, it takes you to this page. You can see all of our upcoming classes as well as our 3 years plus worth of recording back there. Come down here, hit that heart. It opens up a new tab. Hit that like button right there. Click on this plus icon, this thumbs up icon. That takes you to another new tab. And hit that like button. Again, the more you do that, it helps get our content out to all of our followers. But based on how their algorithms work, so we really appreciate those who do hit that thumbs up icon on both the Twitter and Facebook, and for that matter also like on LinkedIn, for example. Their algorithm's even better for those who click the like button or thumbs up icon on our LinkedIn post. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here. All right, when we take a look at what's driving the price action today, this is about as safe haven of a trade as you could possibly have. Gold was up and the dollar was up, and that was it. When they both go up together like that and nothing else is higher on the day, then that is risk off. That is, I mean, again, it's only one day. We haven't had any days like this until today. But that is about as risk off of a trading pattern as you can possibly get. Of course, stocks were all down, including small caps and Qs to the same degree. Long-term bonds were down even more, so a big jump in long-term yields, as well as a big jump in short-term yields. When you look at the 2-year note, you can see it jumped all the way up to 52 basis points, so 11 basis points there. When you look at the 10-year yield, it jumped up 12 basis points. So real significant jump higher here up to 1.57. So big jump higher in the 2-year. That's reflective of interest rate hike expectations ramping up today pretty significantly. The June contract went from a 50-50 odds for a rate hike up to 56%. That was all the way up to 66% earlier today. I'd venture to guess it's actually where it's going to probably be by the time things shake out and the liquidity comes back in by the time the market opens tomorrow. So that's a very high odds, and you can see December odds for a rate hike jumped up to 80% earlier today for 2 hikes, and then a 50-50 shot for 3. So that's a pretty significant change, all based on that inflation data that we got from basically the CPI. Put a lot of in scares, right? When you have real estate outperforming, commodities outperforming most equities, commodities outperforming bonds, that's an inflationary move. Gold is up. The only difference is the dollar was this. I mean, that dollar was up 1%. That's a very high move for UUP. Let me come over here. Nope, not to that one. It is to this one. Let me just show you how significant that is. I mean, that's the biggest bullish move we've had on the UUP all year long. And we have it, it's been a while since we had that kind of move before, back over here on 6/11 of 2020. Let me just pull this chart up here, and let's go back 5 years to give you an idea of where 6/11 of 2020 was. It was right there. So we were well below moving averages. Remember, you get your biggest moves when you're below moving averages. It's a very different than this go around where we're above all these moving averages. This is more of a breakout move where that June 11th was more of a bounce, right? And of course, here, some of these other days that were significant bullish days too. If I were to zoom out, there in the COVID move, we had a lot of down days. You know, from 310 to 319, we had some pretty significant up days. Starting with that one right there, below moving averages, all the way up to 319 that day when we were far up above it. But that was like that was the weakest part of the COVID response that we have seen. And then when you look at, you know, how gold performed during those same time frames. Okay, let me change this out to 5 years too, and I'm gonna compare gold here to SPY. Here is 2020. You can see gold also took off on, let's see, right here would be 310. Let's just go 2 years so we don't have to try to zoom in as best as we can. It doesn't really allow me to zoom in very well, but here's 310 right there, and then you can see gold rallied all the way up to March 19th, March 20th. So those 2 days were also very risk-off days. Look at the breakout in gold on stocks above the 50-day moving average. Still well below the 200, but above the 50-day moving average. Look at the breakout on gold versus bonds, all the way up to the 200 again, well above. Big move. So big break on gold, big break on the dollar. Very significant in terms of risk, safety trades. And like I said, you know, when you get these big 1% or more moves on the dollar, there's another one there on, that would be June the 14th of 2018. So if you come back over here to June the 14th of 2018, kind of a very similar kind of a pattern that we got right now. We were just getting a golden cross again, and we continued the trend. It kind of established the trend. Very similar. We're just getting a golden cross again. And, you know, we've been bullish, and then now this kind of really reestablishes the bullishness. Lots of volume, too, well above the average. So big breakout move on the dollar, getting back above this 38% retracement, which is 38% of this decline that the dollar started back post COVID low point for risk. The dollar fell during that period, and now we're rising, you know, and breaking an important resistance and making potentially a move all the way up to 26, which would be a pretty significant rally. It'd be back up to these old lows from the end of 19, beginning of 20. For the euro, US dollar, the equivalent end of 19, beginning of 20 would be down into this area. Right, I think you're probably going to be looking more at about 1350 by the time all is said and done. So, you know, good significant move. And if gold is following suit with that, if dollar and gold are going up, and you can see gold on an absolute basis, the breakout there back above all these moving averages. It's been in the death cross, but now easily above the 50 now and the 200. The 8 and 17 have crossed both the 50 and now the 200. The 30 is crossed above the 50 here, close to crossing back above the 200. So it looks like gold's about to start its own golden cross situation after this kind of, here, let me get rid of this one. After this kind of extended decline back to 38%, getting back above the 23, which would be 175, would be a significant break for gold. And again, would be a reflection more of risk off than it is of risk on. At that point. So interesting day, and all has to do with that inflation figure and the expectations for rate hikes ramping up faster, because again, as I mentioned in my class today, it's not the fact that they're raising rates. That's not bearish, right? It's actually a good thing. The markets are always bullish when the Fed's raising rates. The difference is where their yield spread is already. And I guess, you know, it's just to kind of visualize it on this chart. It takes a minute for it to load up with the Fed data. I mean, we are pretty much right at 100 basis points gap between the 10 and 2-year Treasury spreads. So if I were to go back out here to that CNBC site, as you saw, we're at 1.57 for the 10-year, and we're already at 0.51 for the 2-year. And this is, you know, which is well above the current rate, right? Where the right here is where the 0 to 25 range is. You know, we're well above that. So, That's a significant. I mean, we're already to 100 basis points. By the time we probably hike rates, we will be well below 100 basis points. And so it's this idea of we don't have, like, for the Fed to invert the yield curve, it only has to go. I mean, and we didn't get up here. It doesn't have this runway to invert it. It doesn't have this runway to invert it. The runway is starting a lot closer, which is a little different than what we've seen in the past, and that's what makes potentially this rate hike cycle, considering how highly valued, and we're also, valuations are higher now than they ever were over here from a long-term CAPE ratio standpoint. So that puts, that might be the cause of some volatility here. The increasing odds and kind of pushing the Fed to do something they might not want to do is what might be sparking a risk-off environment here that you normally don't get, especially this time of year. So again, that might be the catalyst. We'll see again how the market responds to this 2 days. If we bounce and grind and get that bullish convergence going, then that's normal. From a technical perspective, that's normal. If this risk-off move today is more than just a one-off day, turns into more of a trend, then we've seen the beginning of it today. Right? Today would be the beginning of that, because that's, like I said, more of a risk-off mode than I've seen. Let's take a look at how the sector has performed today. Let's go to, again, just today alone. Right there. And look at today. You can see staples, utilities, healthcare were your big winner, were your only winners. Energy was down. Technology was down. Communication services were down. I mean, this was risk off. XLY was down. A little bit of a bounce up late. Everything, all your big three, technology, discretionary, and communication services, all down the most, with energy really dropping hard. So risk off, very, very risk off. So again, we'll see if this turns into a bounce, which is, again, what I would expect in the higher probabilities. But if it turns into more of this tomorrow, then again, like I said, we've seen the beginning of the intermediate pullback here. It's not quite what we'd like to see in terms of, like, we didn't gap. We filled in today's gap, right? We got a pretty good gap to the downside. We filled that in this morning, so this wasn't a runaway gap. So watch to see if we do get a runaway gap tomorrow. Watch to see if we do gap down by more than, what would that be, 0.5% roughly. If we gap down more than 0.5% and we run to the downside from there, then risk off, right? If we gap down a little bit and then bounce from the open and fill in the gap immediately, then that's the higher probability scenario. So now, to take advantage of that, for our trade idea of the day, I wanted to take a look at a stock that's kind of in a similar pattern, right? Target has earnings coming out next week. It's got a strong bullish posture. It's got an intermediate confirmation signal. Its near-term line was in. It's actually bounced up a little bit since I did this in the Market Outlook Live, but we were in bearish territory. We're bouncing off. So we've had a pullback here. We pulled down. In this case, you can see we actually did get the MACD. It's been converging for a while, and stochastics has dipped below 40. So we're actually better suited for a bounce here than we are even on the S&P. But this is the kind of pattern we're flirting with a 17. We expect that you'll bounce back up, get a new bullish convergence, probably not to a new high, most likely not to a new high, but get a new green arrow, get a new, MACD to cross back above its moving average, but not really go up too much, and then just trend to the upside. That's kind of what I would expect to see from a Bollinger Band perspective. The pullback got you down to the midpoint, but not below it. Perfect. That's exactly the kind of pullback there you'd like to see. The RSI came down towards 50, but didn't get below it. Especially didn't get below 40. Came down below minus 100, but not to extreme levels. So that's the kind of pullback pattern you like to see there. If you take a look at the DMI. We did drop to 25. We did bounce up above 20, but we're not crossing. So this is a good bounce, similar to something like that. It's a good bounce pattern there too. So everything's looking really good for a bounce pattern. Of course, nothing's ever 100%, nothing's 0%, but that's exactly the type of patterns you like to see. So when we look for our trade idea, what we decided to do was come out to December, 37 days out, and do a long call vertical spread. So we're going to not buy at the money. We're not going to buy the at the money, but we'll buy one out of the money and then sell the one further out than that. That gives us about a 2.5 to 1 reward to risk ratio if it plays out. We get a good $1,400 reward for about a $500 risk. If it doesn't, if it keeps dropping and breaks down, then we can get out with a $100, $200 loss or so. But if it bounces and keeps going up, then we get a good reward for the risk that we're planning to take. Even at a worst case scenario, that's a good reward. But a really good reward if we only end up with a couple $100 loss if it doesn't bounce. So that's the kind of trade we did. Again, it's just buying. It's a long call vertical spread. We're buying a call option. We're just offsetting the cost of that call option with selling one that's further out of the money. So it reduces my cost. It reduces my upside, but it also reduces my cost. But it gives me enough upside to make the risk worth it on this trade for a directional trade that's got a relatively high probability of making money here. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new threads with any questions or comments you have. Reply to anybody else's threads, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel as well as our website at marketscholars.com. Hit that thumbs up icon. Like us on Twitter and Facebook and LinkedIn as well. Comment on the video. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.